Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. The U.S. Blacklist Tencent and CATL for alleged links to the Chinese military, targeting the world's biggest gaming publisher and top EV battery maker in a surprise move less than 2 weeks before Donald Trump takes office. Justin Trudeau resigns as Canada's prime minister, setting the stage for a more conservative approach, the latest example of inflation's toll on the economy and global tilt to the right. And a slew of inflation figures due to drop this morning from across Europe. We're going to bring you the Swiss and French data live this hour. Lizzy.
Well, a very good morning. Checking in on these markets, we have futures pointing lower in Europe. We had this big rally in big tech heading up to that Nvidia boss speech. Are we going to have a tepid Tuesday, though? Was it a bit meh? We also had a volatile start to 2025 with Trump wading in on his tariff plans, denying they're going to be pared back. Yields spiking, currently the 10-year at 4.6%. The yen pairing some of those earlier moves, regaining ground at 157 per dollar. The foreign minister wading in to say that there will be appropriate action against any sudden forex moves. And then, as you say, Kriti, we are awaiting that inflation data from the euro area. The beat on German inflation yesterday, backing the ECB's caution. Euro dollar at 104. The countdown to the opening trade starts right now.
Tuesday the 7th, good morning, folks. Let's start the show with a few stats, a few little facts around what is happening in the auto sector. CATL makes around a third of EV batteries. The entire sector, the entire industry. You look at 1 in 3 cars, CATL batteries will be in them. BYD plus CATL make half of the world's EV batteries. We've now got CATL on a US blacklist. We've also got Tencent on the blacklist. You're seeing the market reaction to all of this. What I can't work out this morning is this a geopolitical story? Is this an economic story? Or is this a car sector crisis story?
Is this the stock market story? Maybe today, if we start to see the likes of Stellantis, the likes of Volkswagen, which of course are the major players in Europe that are affected by this, actually getting a hit this morning. The other piece of it is, do they get a boost? Does that just suddenly mean that a lot of the supply that maybe was meant for the U.S. gets rerouted right to Europe?
In theory, there should be no effect. In theory, this is you can't supply the U.S. military. In theory, that's the way that this should happen. But it just highlights this gap. China's got a big lead in batteries. It's supplying the world with batteries. Is that something Donald Trump's going to be comfortable with?
Yeah, and look, we should say Tencent says it's not a military company. There are no specific sanctions here. It just kind of maybe discourages firms from doing business with them. But it is an interesting signal. And it's interesting when you tie it in with Trump saying that he's not paring back his tariff plans, as was reported by the Washington Post. What's interesting about that is, it's kind of showing that they're thinking about what the tariff plans are going to look like in advance of coming back into the administration, whereas maybe we didn't have such a feeling about what they were going to be before the last time.
The line is pretty clear, isn't it? Tariffs are going to be a big issue, and they're going to be a big issue for China.
But what shape are they going to take? National security already being mentioned.
This is coming out of the Biden administration, though. This isn't Trump. This is Biden doing this, and you therefore wonder, how much further Trump will go.
This is Biden, and this is the Pentagon under Biden as well, which is kind of crucial here. This has been a bipartisan issue. This anti-China rhetoric has been a bipartisan issue. It's the only thing that Democrats and Republicans can agree on in the United States, which is why this is so easily done. So many of these kind of policy items that you are seeing that are from tariffs, that are from blacklisting, that are from even bringing manufacturing and chips and the like to the United States, it has bipartisan support. It's why, for example, in the Biden administration, funding into chip manufacturing in Arizona, which is traditionally a red state, was met with such love and passion because, again, it's an anti-China bipartisan issue.
But here's the thing. Yes, chips is a massive weak spot that the US has had. Batteries, we knew that China had a lead in batteries. This just reinforces how big a lead there is in battery technology, how dominant China is in this space. Can we see a European EV industry without China? Can we see a US EV industry without China? Not even just the batteries. They also control the stuff that goes into the batteries. The chemistry is largely controlled by China here as well.
Yeah, China, and then I think it comes out of kind of parts of Africa. There's the lithium industry in South America as well in terms of the components. Let's talk about chips, which is, of course, such a crucial piece of this equation. NVIDIA has been the darling of the chip-making space. It's driven a lot of these tech gains, maybe until last night, maybe until today. Jensen Huang made a keynote speech. Didn't really ruffle that many feathers.
So up until now, he's made a speech. Markets loved it. Love what he has to say. This is fantastic. In some ways, what he talked about last night was incredibly sensible. He talked about broadening out the AI story and how that's going to be the sort of the next step for NVIDIA. But what did you say this morning? Meh? Kind of a meh reaction. We don't often start the show with a meh, but I love it. That's the way that the market is reacting this morning.
But that's because he's set expectations so high. But when you delve into what he has been saying, it's interesting. You've got working on Uber for self-driving technology, the Toyota partnership. Toyota shares up off the back of that. More on gaming, data centres as well. It's all good stuff. But we've just come to expect such high, big things from NVIDIA.
But this is the logical next step for AI. How do you start using it? This is the puzzle that NVIDIA's got to solve. How do you make this part of a wider narrative, not just a narrow narrative which has driven its stock and the sort of the hyperscalers, etc., over the last year? How do you broaden it out into the rest of the world?
Well, into the rest of the world, into the rest of the tech sector. I think we talked so much about that concentration risk being in the Mag 7, being in some of the chip makers. Even within the tech story, it's really been driven by only NVIDIA. And I want to bring you this chart that you see on your screen right now, which basically the white line is showing the Philadelphia SOX index. The yellow line is showing the NASDAQ composite. And the green below it shows the correlation between the two. And if you look really, really closely, in March, you saw a big, big correlation. That's the NVIDIA story. All the chip makers getting involved, all of them trading on those Biden grants as well. You look towards the end. In the last 2 months or so, that correlation is starting to drop, which means that the tech outperformance, again, to your point, is actually getting more narrow. It's an NVIDIA story and not a broader chip-making story. Some would call that the Biden unwind.
Maybe. Is it the NVIDIA unwind? That's the problem that they're going to face. The next step could be the NVIDIA unwind. If that doesn't continue to deliver, then there's a problem. He has to broaden the narrative out. They're producing a PC, which is quite cool.
Yeah.
Is it a gaming console?
No. I think it's a computer. It's a data analytics tool that basically you will have on your desktop, which will have effectively a kind of an NVIDIA chip at the heart of it, and you're going to be able to run AI on the desktop, which is pretty incredible as well. Let's talk about Canada.
Yeah, let's.
This feels very familiar. This story now.
Yeah, just the latest G7 leader to be falling prey to the cost of living crisis around the world. You know, the dominoes falling. You've had Sunak, Biden, now Trudeau. Scholz looks set to lose that German election. So you'll have the Liberals picking a new leader, an election almost immediately likely after they're announced. The runners and riders, if we look at them, you've got Chrystia Freeland, the woman who arguably delivered the fatal blow to Trudeau's premiership. Mark Carney, the former Bank of England governor, who we know so well, Bank of Canada as well, should say, chair of Bloomberg Inc. But really, it's going to be an uphill battle for whoever's leading the Liberals. It's pretty academic.
Who cares about who these people are?
Exactly.
I kept reading stories over and over overnight which talking about who will end up leading the Liberals. It's like, I think there was a nice cartoon in one of the Canadian papers talking about this, which was sort of a plane hitting the ground, and just as it's hitting the ground, Trudeau pops out with a parachute. This is something that is going to be... This is about an election. This is about the Conservatives taking over. This is not about who will ultimately lead the Liberals.
I think the phrase is moving deck chairs on the Titanic.
Yeah.
It's also, I mean, I think it's this shift that you've seen to the right in Canada, in France, in Germany. It's an economic issue. This is the fallout, the effects, the after effects of inflation, of affordability, especially of immigration. We know that Trudeau's really changed his stance on that. So it's kind of the decline of centrist politics. You've seen that with Biden. You've seen that with Trudeau. You've seen that with Macron as well. I think the housing piece is such a crucial part. Remember, from an economic perspective, Canada is no stranger to housing issues. The housing crisis in Canada is ongoing. The affordability story is ongoing, and has one of the most dovish central banks in the world to try to address these issues, to stem these issues, and it hasn't been able to.
It's got a lot of space, not a lot of housing.
Yeah.
They all live below a little line Canada. Anyway, let's talk about what is coming up on the show today. Felix Kalen, SocGen, Head of Emerging Market Research, is going to be joining us. Obi Ejikeme, Carmignac Fund Manager, joining us as well to talk about these markets more broadly. We've got a bit of data that we need to work our way through as well, Lizzy.
Yeah, at 10 a.m. London time, we get Italy CPI, seen as broadly stable in December. 10 a.m. London time, Euro area CPI expected to tick up in December, especially after that German print beating expectations. And then at 3 p.m. London time, out of the US, we get the JOLTS numbers and ISM services. So job openings, I should say, expected to stabilise, and really we've seen services expected to expand modestly because of the holiday season, so maybe a boost there as well.
We'll see. We'll see what the data is going to be. Do we feel like we're being driven by the data at the moment?
I think you have to differentiate between the soft data and the hard data, right? You've got the confidence to actually get the proof.
Or are we just being driven by politics? It feels like politics is the narrative. 18 months ago, every single data point was manically followed and kind of dissected and sliced and diced to figure out what exactly was going on. We seem to let some of these big data points just go kind of by the wayside now. It's all about tariffs, it's all about politics.
But we have seen even traditionally, when you look at the likes of the euro, for example, it only really moves on German inflation numbers. You start to see the France story, you start to see the Spain story at least tick higher in the knee-jerk reaction. We'll see if we get some of that today. We'll
watch out for that. Keep an eye on the gas story. That is a big one, and that could continue to move markets here in Europe and provide some inflationary impulse. Let's talk about what you need to know. We also need to just reference, actually, the next sales numbers. Let me just bring those up for you and see what is happening there. I did see them flash across my screens just a moment ago. So let me just bring you the details on that. Boosting its full-year pre-tax profit. This is interesting, because actually I thought the BRC data, Lizzy, was quite weak overnight. So the UK consumer is not looking particularly solid at the moment, but full-year boost from on the pre-tax profit line from Next. I haven't seen some commentary on that, but I'm sure doing very well. This is a company that continues to outperform the retail sector broadly, so we'll see what its stock does at the get-go of trade a little bit later on. Not exactly an exciting few sessions into these numbers, as you can see. France's new finance minister is aiming to reduce the country's deficit more slowly than his predecessor. Eric Lombard told French radio he's targeting a deficit of between 5 and 5.5%. The previous government was looking for 5%. He's also saying that the budget will contain around 50 billion euros of tax rises and spending cuts. That's also 10 billion euros less than the last government's proposals. Politics intervening there. Bloomberg has learnt that Bridgewater Associates dismissed 7% of its workforce yesterday. The cuts affect around 90 employees at the world's biggest hedge fund, which is seeking to remain lean and maintain the flexibility to hire top talent. In a statement, Bridgewater says it has been focused on, quote, setting big goals and is doing hard things during good times. And Federal Reserve Vice Chair Michael Barr is planning to step down next month. Now, that's more than a year before the end of his term. The decision, of course, bypasses a potential battle with President-elect Donald Trump over his position. His departure raises questions about plans to force U.S. banks to hold more capital to shield against losses and a financial crisis. The Fed says Barr intends to stay on as a member of the Board of Governors. So this was the only area that Trump could have had an instant impact on the Fed. The Barr kind of appointee role. And it's interesting that he's decided not to have that fight.
When he said in November that he was going to stay on if Trump tried to pick a fight with him, but he's bowed out before it even began.
I wonder how the markets trade off of this, because you saw some movement in the banks. This is someone who's been very, very tough on the capital rules, as you've discussed as well. It's also something that now that he's gone, the kind of any hurdles towards decreasing those capital requirements in the States kind of falls as well. This is where Europe has to come and compete. This is coming in the midst of Basel III reforms. And this is something that not every member in Europe has tried to address in terms of competing. The Swiss government, for example, with UBS, something UBS stock trades off of, has been this question of, do you actually start to see these Swiss capital requirements not drop and therefore hold UBS back in a way that maybe some of its European peers can?
Could also affect Europe via the yield curve, the shape of the yield curve. So what happened yesterday was the US yield curve steepened up because less regulation means that the banks can do more at the front end, and therefore you see yields dropping there. Curve steepens up on the back of that. That, again, is something that is affecting... you look at what's happening with the UK 30-year right now, and that story is getting quite extreme for Rachel Reeves to manage.
Suddenly, bank balance sheets very much in focus. We're going to talk about that and more. Coming up on the program, used Rolex prices fall to 3-year lows. We're going to bring you the latest from Bloomberg's Subdial Index. I know, guys a big fan of this one. Plus, the Microsoft CEO touts the tech giant's $80 billion AI investments. We're going to head to India, where Satya Nadella is giving a keynote speech of his own. Up next, Donald Trump's looming presidency, though, continues to dominate the market chat. We'll discuss the latest moves around the world. Stick with us. If you have any questions of your own for our guests or for us, send them to us. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
They're having trouble communicating how they're likely to react to the Trump policies. Obviously, if tariffs are broad-based, that is one effect. If they're much more targeted, as the Washington Post report suggests, that has a different implication. So there's a lot of uncertainty about what Trump policies are going to be.
That was, of course, Bill Dudley, a Bloomberg opinion columnist, formerly of the New York Fed. He doesn't know, nobody seems to know. I'm assuming that some people know what the Trump tariff policy is going to look like, and then we can start to maybe extrapolate in terms of the impacts in various areas, including the Fed. Traders certainly having a bumpy ride yesterday, as we saw various reports coming through. We saw this Washington Post story. That obviously had an impact. Then Trump sort of dials that back. We did get through 104 on euro-dollar yesterday. So let's talk about the market reaction. Valerie's here with that.
Guy, those reactions to those tariff articles very much focused in the FX space. We had this bout of dollar weakness. A lot of the move, though, taking a part on the euro-dollar pair. Euro-dollar rose more than 1% yesterday on the back of these headlines, and it flirted with the 104.50 handle. And I think that what this shows us, Guy, is that there is a lot of short positioning in euro-dollar at the moment. We even had reports from the street saying there was a flurry of options activity yesterday, with option volumes surging around these headlines. I think it shows that we already have seen some shorts getting stopped out in this currency pair. But besides euro-dollar in the FX market, we also have our eye on what's going on long end of the Treasury market. We had those 30-year yields yesterday hitting 14-month highs, and it's gone global overnight. We had the Japan 30-year yields seeing highs not seen in 15 years. And then here in the UK, those UK 30-year yields rising once again, hitting highs we haven't seen since 1998. We do have a 30-year bond syndication taking place here in the UK, so this one is one to watch. That fiscal headroom for the UK government really getting eroded by what's going on in the Treasury market. But we also need to keep our eye on what's going on in the yen. If we get this bout of yields rising in the U.S., what we do get alongside of it usually is some yen weakness. We got that overnight. We got yen hit a 6-month low versus the dollar. It attracted some verbal intervention, has since erased that weakness. But keep an eye for verbal intervention coming again.
Valerie, yeah, we'll certainly keep an eye on that one. Then we'll see what follows it. Florian Ialpo, head of macro at Lombard Odier Investments, joining us on set to carry on the conversation that Val started with us. Valerie started with euro-dollar through 104. She's talking about the fact there's a lot of shorts out there. Some of them got unwound yesterday. Broadly, to what extent are European assets kind of a coiled spring at the moment? Everybody hates them. Nobody wants to own them. You get any kind of a piece of good news, or maybe even just some negativity in the States. How much of there is the possibility, do you think, that Europe is actually under-owned, underappreciated right now, and could bounce?
It's actually very large. I think it ties to the lack of perception that something is happening in Europe, which you can't see really in the PMIs as published from yesterday, or the final version we got yesterday. There is a recovery ongoing in Europe at the moment. You can see that when you look outside of the PMIs. Look at the European Commission indicators. They are showing a majority of improving data, both on the service sector and some on the industrial sectors. But it's just the beginning of it, and it's very difficult to see at the beginning of it. So in Europe, you have a lot of bad news priced in already. You've got this low euro. You've got this recovery that is only starting, and that recovery can come with a tad more inflation. That places you in a situation that, well, basically, European equities could be capturing some of that in the next 12 months. Now, remember also that every first quarter of the past 3 years, we've seen Europe outdoing expectations massively. Every Q1, I'm told, like, the CAC 40 is a new NASDAQ for 3 months. So I think we're exactly in this situation. Europe is about probably to deliver nice returns.
After that, we tend to fall flat. And there's various reasons for that falling flat. Is this time around going to be the ECB being too cautious? Like you talk about the inflation problem. Gas prices are up 50% circa year on year. You've still got wage demand reasonably strong across many of the European economies, the Eurozone economies. Is the ECB going to be too cautious and kill off this recovery once again?
It's one of the three main risks, I would say. We are currently seeing higher inflation numbers. They're not only higher, but they are surprisingly higher, which is a bit different. You have base effects, true, but also there is a formation of inflation pressures in Europe. We started capturing that back in August last year. In August last year, our nowcasting indicators, inflation nowcasting indicators, were saying you get 80% of the data in Europe, which is pointing to higher inflation 6 months ago. At the moment now, that number is 45%, so say 40%. Yeah. So you see, we don't think it's a long-lasting trend, which means that the ECB could decide to look through that trend. And if it does so, then, well, we can put on the side one of dangers
for the
CAC
will become the new NASDAQ at that point, maybe.
What does that do in terms of setting up Europe in terms of, you talk about this kind of coiled spring coming back. Does it set up Europe for more vulnerability towards an inflation shock? Energy prices. Guy was talking about the euro versus gas prices, for example, and trading off that. Does it build up those correlations between more commodities the way we saw in the States 2021?
Mm-hmm. I would say it depends on economic growth in Europe. If you get stronger growth than expected in Europe and you get this cost push inflation surging, the combo of that can be very bad. Now, we're not in that situation. Germany is not doing good. France is exposed to political uncertainty. All of that is weighing on the Eurozone's growth, and we're very unlikely to see growth above potential in Europe within the next 6 months. If that would happen, then it would be a catalyst to accelerating inflation.
Well, you're talking about this cost push inflation. Last time we talked about that, it weighs on margins in a really, really significant way. And the argument for a lot of European companies has been that exposure to the U.S., that consumer resilience in the States, arguably stimulus in China, is help keeping some of these companies afloat. But if you have margin pressure regionally, doesn't that kind of kill any sort of cushion from the rest of the world?
It does, which means that the only way you can gain these through quantities. And that's when this argument of an economic recovery in Europe fueled by ECB cuts is essential to your investment policy. If you don't get that, then you're going to kill the first offspring of this recovery, and then you can move back to your US tech 5 names.
Florian, if I can bring us to the UK, we were talking about Rachel Reeves having to look out for the bond vigilantes. You've had all these gloomy business surveys, gilt yields on the 30-year back to levels when Gordon Brown was Chancellor. More broadly, because so many fingers are pointing at her tax hikes, do we need to be worried about fiscal consolidation in 2025 and the impacts?
We need to be worried about fiscal consolidation because we've profited from fiscal expansion so much over the past 3 years. Fiscal expansion has been one key argument sheltering investors from the central banks' policies across the world, meaning higher rates, slowing investment and consumption, and that should have weighed on profits. Now, we've benefited from that, and we know we need to move away from it because it will surely become unsustainable at some point. When is that point is very difficult. At the moment, what the market is pricing is that the countries which are not yet on a, let's say, improving trend are getting punished. The UK and the US are the best examples of that. On the other side, you get Japan and you get Portugal, for instance, which are actually in a much better position.
Florian Yelpo, Head of Macro at Lombardo DA Investment Managers. Lovely to have you with us around the table this morning. We thank you. And coming up, we're going to go back to Canada. Justin Trudeau resigning after 9 years as Canadian Prime Minister. We'll look at what led to his downfall and the runners and riders to replace him. That's next. This is Bloomberg.
I have always been driven by my love for Canada, by my desire to serve Canadians, and by what is in the best interests of Canadians. And Canadians deserve a real choice in the next election. And it has become obvious to me with the internal battles that I cannot be the one to carry the Liberal standard into the next election.
Canadian Prime Minister Justin Trudeau, they're announcing his resignation amid growing discontent over the cost of living and weak economic growth. His departure sets the stage for a dramatic shift in Canada's economy away from progressive policies towards a more conservative approach. Let's bring in Bloomberg's Jill Deesis over on the EcoGov team to walk us through the dynamics at play here. Jill, at the core, politics aside, this feels like an economic story at its core. Walk us through the extent that's true.
Yes, it really is, Kriti. At this point, what you're seeing kind of happen with Trudeau here is not that dissimilar from what we saw really all over the world last year during one of his massive election years for a lot of leaders, which was that you saw economic dissatisfaction, issues of inflation topple leaders or severely weakened leaders pretty much all over the world, regardless of which political party they belong to. In Canada, the story wasn't entirely different there. I mean, you had rising inflation after the pandemic, which while the country worked to sort of try to get that under control, still you had incredibly high grocery prices that are kind of settling in as severe causes of discontent with everyday Canadians. And then you also just saw a lot of people within Trudeau's own party kind of either push on him to resign, otherwise split with him. All of this really kind of coming together just a few weeks ago when his finance minister, one of his most trusted advisors, actually stepped down over some policy disagreements with Trudeau. All of that really coming against this backdrop of Trump coming back into the office in the United States, sort of pushing this idea of potentially more tariffs on Canada, all just really created this concoction that led Trudeau to step aside at this point.
And Jill, with all that discontent, such an uphill battle for the runners and riders looking likely to replace him within the party, are any of them going to stand a chance of becoming and staying PM?
Well, Lizzy, I don't know about actually becoming PM, but at least in the leadership election, which really needs to take place first here, there are a couple of names that do seem, likely to really contend for that. First of all, Friedman, that finance minister that I mentioned who stepped down, she's potentially, a candidate there. We've also heard of some interest from Mark Carney, that's the former governor of the Bank of England and of the Bank of Canada, also chairman of Bloomberg, who, have kind of stepped forward, put their hats in the ring as potential candidates here. There's a couple of others that are, all coming together there. But ultimately, I mean, opinion polls really have the Conservatives pretty heavily favored to actually take the next election, which is going to have to happen sometime between April and October of this year. So whoever becomes party leader, sort of taking over for Trudeau, really faces a massive challenge, massive uphill battle to actually becoming PM.
So let's assume that the Conservatives win the next election and we go with what the polls are telling us, which is always a little bit risky, but nevertheless, what will happen to Canadian politics under a Conservative government?
Well, really, I think what you're looking at is, probably a dismantling of some of Trudeau's signature policies here, particularly when it comes to some of his carbon policies, immigration. You have the Conservative leader, Pierre Poilievre. He's really kind of indicated that he wants to take the country in another direction, has kind of, portrayed himself a bit more in that sort of Trump-like strongman type of attitude. And so what you're likely to see is, is a country that does take on more conservative policies and kind of puts that forward. So it's a really interesting moment for Canada because, Trudeau was in office for quite a long time, had kind of pushed this very progressive agenda. And so the fact that, you do see potentially a rightward swing in Canada, I think does have some pretty interesting global implications. And then when you're pairing that with the fact that, President-elect Trump in the United States is coming into office, I think it's going to make for a really interesting political year for Canada.
Jill, great stuff. Thanks for the update. Really appreciate it. Bloomberg's Jill Deesis on what is happening in Canada. Just a word of note. Mark Carney, of course, is chair of Bloomberg's board of directors, Bloomberg Inc. While we're talking about what is happening with the politics, we've also got a bit of economic news breaking. So you've got Swiss CPI coming through broadly in line. I think the core number is a little soft. You're getting a bit of a reaction in Euro Swiss. That spike probably slightly overemphasises the level of the move that we are seeing here. take a look at the slightly longer-term charts over the last few days, we're pretty much still in the range. The euro, though, has been gathering a little bit of momentum. Yesterday, through 104 against the euro, against the dollar. Euro Swissy now trading at spot 94.17. So a little bit of a tick higher we are watching this morning in terms of strength for the single currency, Lizzy.
In terms of other market moves this morning, shares in Tencent and CATL have both tumbled after both were blacklisted by the US for alleged links to the Chinese military. The two companies saying that their inclusion is a mistake and they have no ties with the People's Liberation Army. Well, let's speak now to Phoenix Callan, who is Global Head of Emerging Markets Research at SocGen. Good to have you with us. We've seen the impact of Biden's blacklisting in the Asia session. We also saw Trump's tariff denial of the WAPO report weighing on EM stocks and currencies yesterday. I just wonder very broadly as we start 2025 how one is meant to deal with all of this uncertainty and when you actually expect certainty this year.
Yeah, it's such a difficult question. I think at this point in time, I would characterize this environment as still kind of the darkest before the dawn. And we are yet to see kind of daybreak breaking through, and it's getting pushed out further and further by the kind of dichotomy that we're seeing out of the U.S. Strong, resilient data still, especially from the services sector, versus the rest of the world, versus Europe, versus China, where stimulus has been still awaiting. Investors have been awaiting for those to come. And they've been kind of stalling, trying to play for time, trying to see what the actual impact is going to be from the Trump administration, what kind of tariffs will be announced, and I think trying to preserve some dry powder to respond to that. So I think in this kind of period, so much policy uncertainty is weighing on EM markets. At the same time, we've got that strong dollar move. We're seeing right now a 98% correlation between DXY and EMFX. So it explains 96% of the variation in EM currencies. So it's just such a strong one-for-one linkage between those two, and that's getting EMFX pounded essentially.
Yeah, I mean, you also saw yield spiking off Trump's denial that he's paring the tariff plans. I mean, do you see the 10-year yield going above 5%? Because, of course, that impacts the outlook for EM bonds too. And if you do, when do you?
So we don't. We think that it's unsustainable for U.S. Treasury 10-year yields to go beyond 5%. When it gets up to that level, it becomes much more restrictive for companies, and essentially that kind of sows the seeds of its own demise, and things come back down, recession risk really rematerialize, and then it crashes again. And so the cycle kind of repeats. And so we are expecting a much more range-bound performance in U.S. Treasury yields, but yes, with a trend higher because of those fiscal stresses that are still going to materialize on the U.S. balance sheets.
Nevertheless, what is it, 300 bips now between China and the U.S.?
Indeed.
And Chinese bonds yields continue to come under pressure,
yes,
and drop. How much longer can the Chinese authorities tolerate that without letting the currency go?
So I think it's a question of what's the pace that they want to manage that depreciation to happen.
Yep.
And it seems like they don't want it to be any kind of fast pace that would signal more short interest in the market. They want it to be very, very gradual.
So where do you think it takes us?
So we're targeting 7.5 by mid-year on dollar CNY. So that's still, some room for it to move, and a faster pace than we've seen over the past year.
Do you think that would be enough to compensate for tariffs?
No.
Right.
Not at all.
So do you think it could go further if we get big tariffs? Do you think there will be a desire to use the currency maybe to hedge against those tariffs?
No, I don't think they want to go down that route of using the currency as a means of kind of shifting the impact on the economy. They don't want to do that because that's going to really undermine investor confidence, consumer confidence as well. That's really critical to support. And it also goes against their kind of broader objective of trying to internationalize the currency. So we don't think at all that they'll try to devalue the currency or let it move aggressively.
Right.
So it's going to be more around trying to find stimulus measures and announce that over time to boost confidence.
Phoenix, when we talk about EM so much, especially in the context of tariffs, we immediately look to the FX space. But now that we kind of know, to some extent, the direction that things are moving in, maybe not the specifics around that tariff threat, I'm curious if there's a way to play it through LatAm bonds, through sovereign bonds, even through the stock market of these various countries as well. Are you seeing it in other assets outside of the FX story?
Yeah, so I think in terms of like the rates, for instance, we're seeing kind of top-ish rates levels in LATAM, where there is kind of much more two-way flows in terms of receiving versus paying interest outside of Brazil. I think there's still lots of question marks around Brazil's fiscal consolidation measures, but still, in other aspects, I think there is a scope for things to maybe stabilize and come back down in LATAM markets. And then, yes, within the currency space, I think it's interesting to note that positioning has dramatically gone back to neutral in places like Mexico, where it was, much more bullish in the spring, and then it collapsed down, and now it's relatively flat. And so we think positioning is not going to be a kind of hindrance, and so there is scope still for MEX to rally. I think if we get a little bit more certainty once Trump comes in, once we kind of have the establishment of rapport between Sheinbaum or AMLO and the Trump administration.
In terms of the carry trade, I'm going to bring it right back to the FX story. In terms of the carry trade, does this almost create a tailwind for the carry? If you start starting to expect these results, I imagine yields would go higher. I imagine that would make the carry trade juicier. Or is the risk too high to take on, to make it worth it?
I think most carry trades are just not worth it. I mean, average annual carry rate is less than 1% per year versus the dollar. So you have some pockets with high carry, Mexico between 5 and 6%. Frontier markets, of course, lots of carry, but it's quite idiosyncratic in nature. So we like places like Turkey, yes, high carry, Egypt, Vietnam, Kenya. Those are high carry places that we like, but it's quite sporadic and far and few in between. At this point, I think it's still a matter of risk reduction over the coming couple of months until we get much more policy uncertainty coming out of the Trump administration.
So you say that the carry trade may be too risky to make it worth it. But I'm curious, though, in the last couple of years, we've seen a real shift towards the carry trade. We've seen a shift to alternative assets. We've seen shifts away from the stock and traditional stock and bond market plays in this search for yield. If we see an environment again where the stock market, looking at the U.S., arguably Europe, look at Asia as well, is perhaps too expensive on valuation, like commodity sector that's too challenging. Is it fair, or maybe not fair in your opinion, to say that the carry trade could be, and maybe not a safe place to be, and maybe not worth it, but still one that might find buyers or might find investors simply on the idea that there isn't yield in other places? Is that a fair argument?
Yeah, I guess in terms of relative value, yes, that's a fair argument. And it is going to push people to look at valuations more closely in other markets outside of U.S. equities, for instance. But I think because vol has risen at the same time in EM currencies, that's an additional factor that's going to erode kind of those carry to vol metrics that you're looking at. So I think it's quite important to be choosy between what kind of currency you're looking at.
What kind of clarity would you need to see to change the picture? What kind of clarity do you need to see from the Trump administration? Because that seems to be what we're all waiting for. Does the picture change come January the 20th? When do you think the picture could change in terms of giving you the kind of a steer on what you need to know to start making more nuanced calls in terms of what the effect is going to be? Like, how difficult is it at this point in the year to make calls pre-inauguration about what the rest of the year is going to look like?
Yeah, it's very difficult because we're just dealing with headlines and...
Yeah, we're trading headlines at the moment.
Yes, exactly. I think if we have answers to questions around, let's say, what is the renegotiation of USMCA, if that occurs, what's that going to look like? Is there going to be some sort of immigration border deal between the U.S. and Mexico? What is Sheinbaum's response to tariffs? What's the level? What kind of targeted tariffs might the U.S. impose on Mexico, and on what sectors?
That's a long list already.
Yeah, but I mean, it's going to be such a kind of time-consuming process for this to materialize. It's going to take lots of months, even possibly into 2026, for all of this to work its way through. So I think it's a matter of maybe gaining a little bit of confidence, one measure at a time. Yes.
It's quite a year.
God.
You certainly gave us quite the laundry list there. Phoenix Kalin will leave the conversation. They're global head of emerging markets research over at SocGen. Guys, she was talking a little bit about the currency picture as well. We talked about it from an FX space and EM space, even a little bit of bonds there as well. It feels like the consensus around the dollar still seems to be the story. Weakness in EM, weakness in the euro, weakness in China. That's the theme.
But are there coiled springs out there that are going to unwind? Are we going to see big events where actually you get some really big moves on the day as you start to get clarity to the point, as you start to get an understanding.
Yeah.
Some of these, where are they going to pop up? Where are they going to emerge?
Yeah. And inflation, of course, a key either tailwind or a hindrance. I'm not really sure which it is. In Europe, it starts to feel like something people are welcoming. I mean, this is something we're getting as, of course, the French CPI drops across our Bloomberg terminals as well. You're seeing a little bit of a tick higher in the euro. The preliminary data from December rising 1.8%. The estimate was 1.9%. Not a ton of movement in the euro, though. We should mention the expectation on the street was that CPI would come in potentially at 2%, driven by a little bit of energy prices, a little bit by about food prices. We don't seem to be getting that.
So, but we're up from 1.7, so the inflation's ticking higher.
Yeah.
Is this just a short-term phenomenon, or is this something that is going to gather momentum? To your point of maybe we're not seeing, I need to go into the breakdown and have a look at exactly what's happening. What the breakdown is telling us about energy prices. I was looking at gas prices yesterday. Gas prices are up 50% year on year in Europe. Now, we're not back to the kind of energy crisis days in terms of the kind of stratospheric prices we were talking about. But gas prices are going higher, and we're depleting resources quite quickly, and that means that gas prices are going to be a problem not only this winter, but potentially next winter, which means prices are going to remain elevated and potentially continue to climb. How much does that need to be factored into our thinking? So are we in the foothills of another resurgence of inflation? And is that going to basically tie the hands of the ECB?
Well, Florian says we're only going to get a tad of inflation.
Yeah.
So let's not be overly cautious if you're on the ECB.
Let's wait and see. I suspect the ECB is quite divided on this one. Let's talk about what we're going to be doing next. Excuse the pun. We're going to be talking about what is happening with the retailer. This huge UK retailer warning of a slowdown in sales and profits over the coming year as tax hikes take their toll. This is finger pointing at Rachel Reeves. We'll come back and deal with the details in just a moment. Plus, we'll look at some of the other stocks we're going to be watching at the open. That is coming up next. This is Bloomberg. So the early look at French inflation in December, a little tick higher, but not as much as maybe the market was anticipating. What should we read into this data? Because energy is definitely ticking higher here. Ven Ram, Bloomberg MLive cross-asset strategist, joining us to work our way through the numbers. Ven, what do you make of the data?
Well, morning, Guy. I mean, I think that the French inflation speaks to the ECB's problem. You saw inflation ticking modestly higher, even in an economy that has been beset with prolonged political uncertainty. Yesterday, we saw German numbers tick higher, much higher than a forecast as well. So that speaks to the euro area inflation that is due later today, that is going to be ticking a lot higher. So what does all this mean? All this means that one of the most mispriced corners of the markets at the start of 2025 has to be the ECB's trajectory and its reaction function. Traders reckon that the ECB will cut rates so deep as to take its deposit rate well below 2%. I think they are barking up the wrong tree here. The Taylor rule, which is the holy grail of central bank policy making, suggests that the ECB's neutral rate is somewhere between 230 and 250. If you ask the ECB speakers, they are suggesting a range between 2 and 250. So even if you take 2 and 250 at their word, the markets are essentially saying that the ECB is going to take its rate well below neutral territory. That is not happening. If you look at gas prices across Europe, if you look at inflation prints that are coming out of Europe, that's not happening. What the markets are fearing is that the ECB will have to cut rates really deep below neutral if Trump levies the tariffs, which is possible, but it is not my base case, which is why that is especially so in a world where the Fed is nearly on hold. The ECB isn't on autopilot and isn't about to take its rate well below neutral unless the economy falls into an abyss, which I don't think is the case.
And meanwhile, then, we've been talking about the threat to Rachel Reeves from the bond vigilantes, the 30-year gilt yield up at Gordon Brown as Chancellor levels 25 years ago. But the BOE, if we can talk about that, why are the markets factoring in just 2 rate cuts from the BOE?
The markets have very good reason to be sceptical of the BOE, Lizzy. Just look at what is happening to the inflation break-even rates there. The 2-year rate has shot up by, 50 basis points since the government's autumn budget. that rate estimates that inflation will be something like 3.6% over the next couple of years. So the question before the BOE really is, where should your benchmark rate be if inflation is approaching 4%? As you know, the BOE rate is already at 4.75, so the room for the central bank to cut rates willy-nilly in that scenario is rather limited, and that is why if you look at gilt yields, two-year gilt yields, they found an equilibrium around 4.42, and that is the level they are going to find it very hard to shake off until and unless inflation comes down.
All right, Ben Rum from Bloomberg's Markets Live team walking us through some of the ECB and BOE read-through. We thank you so much for joining the program. MLIV Go for more analysis from him and the team. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Kriti, so Next has reported a jump in sales in the key Christmas period, but also does warn of the potential impact of the rise in national insurance costs as a potential negative going forward for the sector. Now, this sector did have a bit of a mixed year last year. Next did OK, slightly underperforming the big gainer Currys, but there were some big drops like to JD and BME. All of those potentially going to have a read across this morning. Then in terms of Prosus, that one in Amsterdam really fell off a cliff yesterday after a company that is a shareholder in Tencent was added to a Pentagon list of companies that are cooperating and operating with the Chinese military. So that really hit that stock yesterday. We're going to see if that rebounds this morning. But as we can see there, 21 buys, not a single sell. That one is one of the favourite tech stocks in Europe among analysts. Then in terms of catering, Sodexo over in France looks like it's missed expectations. Some of their facilities management businesses not doing so well, according to analysts this morning. That stock kind of bounced around a bit last year, but it does look to be a bit disappointing. Keep an eye on that one in Paris later.
All right, thanks to our equities reporter Joe Easton. And we are looking at FTSE futures down 0.4%. The next story weighing in, Euro Stoxx 50 futures, though, down 0.2% as we head towards the open. Stay with us. This is Bloomberg.
Tuesday morning, good morning. Let's check the rearview mirror before we get started with Tuesday and figure out what happened Monday. European equities actually rallied into the close yesterday, but then what we saw was US markets rolling over. Bumpy session yesterday in the United States. Lots going on in terms of the political narrative. Markets being whipsawed, and you saw that towards the back end of the session. This fade that we've still got to price in this morning, Lizzy, to Europe.
Well, actually, Guy, we've had Deutsche Bank strategists raising European stocks to overweight, but the optimism not feeding through to futures just yet. Euro Stoxx 50 futures down 0.1%. Even more negativity for FTSE futures, down 0.4%. Joe was talking about Next's negative outlook, and you've also perhaps got a bit of that China sentiment feeding through because of Biden's blacklisting. But CAC futures flat to the downside. Look like they'll get off lightly here, Kriti.
Yeah, absolutely. Let's focus on that next story, because that's really where we may see some momentum. As you had mentioned, they did have that kind of drop in their forecast, but they're raising guidance on the expectations of their Christmas sales. That's kind of interesting. So it was mixed dynamics there when it comes to one of the UK's largest retailers. Prosus is another one we've got our eye on. As Lizzy mentioned, we do have that China focus as well. The U.S. blacklisting Tencent and CATL when it comes to alleged military kind of ties. They have, of course, both denied it, but Prosus owns about a quarter of Tencent shares, so we may see a little bit of a read-through there, given the move we saw over in Asia as well. And continuing that theme, CATL, as Guy mentioned earlier in the show, gives the batteries to about a third of EV makers around the world, including Stellantis and Volkswagen. We'll see if this actually moves the market, Guy, when it comes to the opening trade.
Yeah, we're expecting a bit of softness to come through. I think there's a few idiosyncratic stories that I think are going to be interesting to watch. Next is definitely going to be one of them. Just more good news for the EV sector here in Europe coming out of that CATL story. Right, let's get the trade going. Time for the opening trade here in Europe. Let's take a look at some numbers and figure out what is happening here. As anticipated, the FTSE 100 out of the gate a little bit soft, not by much. We're down by, let's call it 0.1%. So a fairly well-balanced market, dipping a little bit maybe now. Let's see what we get elsewhere, because it's interesting. There you go. Stock 600 actually fairly flat. You've got potentially the same story coming through elsewhere, but the CAC could be a little softer this morning. We'll watch how it opens. As you say, there could be names like Stellantis that could be firmly in focus this morning. IBEX is a little bit soft. I don't think there's much really to get our arms around here. So the FTSE 100 underperforms a little bit again, not by much though. Elsewhere in Europe, a flattish open. What's going on below the surface? Let's find out.
Yeah, Guy, when you look at some of the movement already to the downside, I'm going to start with the negativity here. You are seeing some of the more basic resources taking a little bit of a step down right alongside healthcare. It's a little bit of an interesting move. Novo Nordisk, for example, is going to be your biggest index contributor to the downside, your biggest weight, I should say. But you're also seeing tech on the back foot. ASML, which, of course, enjoyed that major rally yesterday, pairing some of those gains today. And as I mentioned, some of the basic resources, Rio Tinto as well, taking a bigger hit. But it's not all doom and gloom for the tech space. We are seeing Schneider Electric actually continue its rally from yesterday, which was one of the major movers. SAP higher as well. So I'm curious how much of that may be a little bit of the Jensen Huang read-through.
Yeah, I'm trying to see if my eyes are correct here. Next shares up 2.7%. Sodexo, after their earnings, down 6.4%. We were mining the chip stocks. ASML down 0.25%. ST Micro flat to the upside. Break it down by sector, about half in positive territory. We've got retail at the top of the basket, higher 0.5%. Healthcare at the bottom, Guy, down 0.7%.
Novo Nordisk is down again. I think it's really, this stock has been under quite a lot of pressure recently. I was just going to try and bring up a share price and see what it's been doing over say the last 30 days. Obviously, we had that big drop at the back end of last year that is worth paying attention to. But Novo Nordisk, you can see, so over the last 30 days, I've got the charts up. Over the last 30 days, the stock's down by 16% still. Last few sessions, it's moved lower and lower and lower. It seems to be a stock that is under pressure right now. Hasn't really recovered, hasn't bounced back, filled the gap that we saw back on the 20th of December when we saw that huge move lower. Just hasn't been able to fill that story. And once again, it's at the bottom end of the stock 600.
Down 40% from last year's highs, our very own Dan Curtis telling me. So a major move, of course, from one of the core six, the sensational six, not so sensational anymore. We should also mention the tech space is, of course, front and center. We are seeing Schneider Electric is your biggest now index contributor to the upside, and that is continuing the move that we saw yesterday as well. At the same time, perhaps getting a double tailwind from maybe the commitment, what we saw on Friday from Microsoft, $80 billion of investment in the AI space. That boosted the tech space yesterday. Potentially a little bit of the tailwinds today as well, despite Jensen Huang not really making a ton of waves in his keynote speech. We are, of course, also hearing from the Microsoft CEO, Satya Nadella. He's speaking right now on the AI theme in Bangalore, India, at a venue, by the way, that is kind of hosted and moderated by the industrial space of Industrial Union, I should say, Industrial Association in that space, in the major tech hub of India. You can see those live shots on your screen right now. But this really brings up this question of just how much of these kind of oversized valuations that we tend to associate with the tech story may actually be justified.
It's going to be interesting to watch which ones of these companies can actually make it work. It was interesting. I read a note overnight. The NVIDIA event was at the Mandalay Bay Ultra Arena in Vegas. People were queuing for hours to get in.
Yeah.
This is kind of... It speaks to the idea that we've reached rock star status for Jensen Huang. Obviously, Microsoft is in that camp as well, but it's fascinating to see just the buzz around what is happening here and the AI story and how dominant it is. Trying to find out what the signal and the noise is here is really difficult, and I think that's going to be the narrative that needs to develop throughout 2025. I still come back to the idea that Jensen Huang was talking about the broadening out. He's talking about how you use AI now, how companies factor it into their thinking. He's talking about bringing computers from NVIDIA to the market. He's talking about how you incorporate it into vehicles. This is the story of 2025. Does that hold up to scrutiny, I think, is going to be the key question, because the use case has to be there for Microsoft, for NVIDIA, and I think that's going to be a fascinating story for this year. It's going to have a massive impact on valuations.
It absolutely will be. Well, let's bring someone who maybe deals with those valuations on a daily basis. Obi Ejikeme joins us around the program, Global Equities Fund Manager over at Carmignac. You have the fun job of figuring out whether the valuations are too high or too low. Juicy enough to get your interest. What do you think?
Yeah, I think, and good morning. I think the challenge is the valuations seem to be excessive. I mean, relative to history, you're paying a significant premium for these stocks. But I think with all investors, we all look at different stocks in the market and different opportunities, and the problem that we really face today is where else do you go?
Yeah.
You know, the growth rates of these stocks are almost 4 or 5 times the average stock in the market, and so realistically, to get that growth, you're going to have to pay a premium. I think when you look at different markets around the world and different growth rates of different economies, whether it's Europe, whether it's the US, that seems to be the trend that's been in place, at least not just for the last 12 months, but the last 24 months, which is to pay or to get growth, you've got to pay some sort of a premium.
You know, one of my favorite quotes is from Dan Ives, a major tech bull over at Wedbush, who loves to say that if people looked at valuations at the Facebook IPO, they would have completely missed the Facebook rally. So valuations may not actually hold as much weight. But when we talk about that, you're saying missing out on this massive growth. That growth requires execution. That growth requires this massive scale up, which you're seeing in infrastructure, in AI, et cetera. But there's still a lot to be left to desire in terms of actually seeing those expectations. It is still all growth over the next 10 years. What do you need to be more confident that that growth is actually going to show up as opposed to just the idea of it in some sort of 1999-esque party?
Yeah, I mean, first of all, this isn't like 1999, and we're seeing the growth already. So some of these stocks are growing their earnings 30 to 50%.
The growth, but the capabilities are growing as well?
I mean, this is to Guy's point about the broadening out. I think that's what we're going to see. So we're at the early innings of this new technological revolution. This is innings 1. Innings 2 will be the part of that. And that's where I think we'll see the growth story go beyond just the manufacturers, just the software companies to other parts of the economy. That's the hope story.
So what does that look like then? We hear all this about agents. You know, is that really going to take the game on that much? Is it going to be a game changer, or is it just a kind of tweak until we wait for a killer app to make them a game changer?
Yeah, I mean, who knows? I think at the moment what's happening is, and you have to bear in mind, there's a lot of volatility around this. When we started on this sort of trend in 2023, where there was a big explosion of the performance of these stocks, it was very, very broad-based. It was almost every stock you could find, and it was a case of, can we just get on the AI on the train?
Exactly.
And then last year was a bit of a reality check, where actually quite a few of the names had very, very poor performances. And so all of us are sitting here going, actually, we need to be a little bit more careful about how this is going to end. We've got to focus on the winning stocks and the ones that have got the best opportunities. And as you rightly say, look for those opportunities in actually sectors outside of technology, industrials, consumer, all the different sectors which will take advantage of it. But at the moment, it's limited to see.
So perhaps a little harshly, I described Jensen Huang's speech earlier as meh. Is that how you see it? Because I know that you don't hold much Nvidia.
It's been consistently one of our biggest holdings. I mean, actually, we've traded around it because it's quite a volatile stock, and as anyone who's held that stock knows, back in 2020, you lost 50% of your value. So I think we have to be relatively careful about how we own it. It's now one of our biggest holdings, and it probably will be. But
you don't love it like Microsoft, though.
Yeah, we don't. I mean, we love the story in terms of the type of stocks that we like, which is these high growth, sustainable growth stories. But I think what you have to be careful about with all of these stocks is to make sure you trade around them. And that means that sometimes it will be one of our top 2 or 3 holdings, but at others it may be down at number 10. And so that's how we've looked at those type of holdings over the last couple of years.
You sat down and you said you're cautiously optimistic. I'm trying to work out from this conversation whether it's more cautious or optimistic. Which one do you think it is right now?
I'm a natural optimist.
Fund manager, of course.
And I'm of course, as a fund manager, but actually, general, I think you have to be optimistic about equities, and it's been a mistake not to be.
Yep.
But I think if you look at where we're starting this year, the reason I'm somewhat cautious is because we are starting on elevated valuations, and we are starting on interest rates which are at high levels. And, we're going to be dealing with all the problems that were well known, which is government policies, fiscal policies starting to impact on growth for this year. And so my caution is, I think some of the best stocks will do well, but I think some of the stocks which are challenged will
and you know what the best stocks are now, right? Of course. That goes without saying. Novo Nordisk. Can I just... you talk about Nvidia, you talk about trading around these kind of stocks, and you talk about Microsoft. Novo Nordisk, back end of last year, 20th of December, dropped massively. Hasn't filled the gap since. Stock still down by 16%. That was a stock that had really high expectations built into it, and we saw that kind of a drop that the market hasn't come back from yet. Is that something you could see being replicated with some of these other, let's call them high expectation stocks around the world?
Yeah, and look, I think there's a broader reason for why this is happening. The broader theme of there being a lack of growth opportunities. Everyone knows about the sort of the Magnificent Seven and these great companies in the US that have managed to perform really well in the last few years. What they're not talking about is the fact that most other stocks are not. So if you look at the growth rate of the S&P 500, for example, and you strip out the Magnificent Seven, we had 3% profits growth last year. That's almost zero.
Yeah, the S&P is outperforming the equal weight consistently at the moment.
So what this is doing is it's raising the bar and the profile for some of the names which are growing a bit faster. Now, that creates a risk. And I think that's what we've seen with names like Novo Nordisk, and even Nvidia at one point last year had a big pullback over the summer. when you've got everybody crowding into a very narrow pool of stocks, then that creates a risk to the valuation of the company. The growth story is probably intact, and if you're a long-term investor, as we are, this is...
But you've got to pick your entry points.
You've got to pick your entry points. And if you're longer term and you're thinking 3 to 5 years out, some of these pullbacks are actually wonderful opportunities to get back into the stocks over the longer term.
You said you're trading around it. If you look at the hedging costs around some of these major companies, they're not exactly easy to kind of bid on the upside, for example. The cheaper hedging costs are from the downside because nobody wants them. So how do you trade around it?
Trading is just sizing for us. So, we can get anywhere between 4 and up to 10% in a particular stock. Now, I think that most of these names are super large cap and liquid, so it's actually quite easy for us to get in and out of them in size. The problem you have when you're in the small cap space or the mid cap space is you simply can't do that. You have too much market effect.
So is your challenge sizing or entry points?
Yeah.
So is picking the entry point easy, but sizing's the difficult bit?
Any fund manager that says they can always pick the entry points is often not telling the truth. But I think what we try and do is we look at the long-term profile of a stock. If a stock becomes cheaper than we believe it's worth, then that's a great entry point for us. And so we're looking at a lot of stocks today, and I'll give you examples. In Europe, there's a lot of companies in today that meet our criteria of being long-term winners that are trading on much, much lower valuations than they have done previously. That's an exciting opportunity for us.
But are you sizing into those positions?
That's a strategy for the year. So I think that's where we're seeing the biggest delta of opportunity. It's not really in the US because all their stocks are trading at the high end of their valuations, but in Europe, a lot of these stocks, because everyone shifted towards domestic Europe, they shifted towards the banks, they shifted towards the domestic European stories, all of a sudden, like Novo Nordisk and like some of the luxury goods stocks, they're trading on relatively low valuations compared to history.
Well, exactly.
That for us is interesting.
If I could squeeze in a little luxury here, Hermes, one of the big names that you hold, do you not worry that luxury is going to get tied into Donald Trump's tariff war on Europe?
I think this is where Europe is, and I'm not the biggest European bull. I think the greatest stocks actually today still exist in the US, but it's the pricing disconnect that we saw last year in Europe and Europe underperforming that's created this opportunity for Europe. The risks that you highlighted, the tariffs, geopolitics, even the currency weakness. There are so many things that Europe has had against it. Even government policy and taxation in Europe. Of corporates. I mean, these are all things that were a massive negative headwind for European stocks last year, and that's last year. So the question is, has the market discounted that? Is the opportunity now this year? And I think that's what looks quite interesting.
I think Kobe just told me that was so 2024.
So last year.
But you mentioned a couple of names that you may be kind of positive on going into the year. Can you give us a taste of that?
Look, I think there's a broad reminder of the strategy that we hold is we look at high-quality companies that are compounding and reinvesting for the future. So generally our view is that we're investing in stocks for 3 to 5 years. I think in terms of the opportunity set, we're looking for stocks where there's been a disconnect of some sort. So that's either the market is focusing on something which is very short-term, and we just discussed a few of those ideas, whether it's geopolitics.
So, for example, SAP, others?
SAP, long-term holding, Hermes, Ferrari, these are some of the names that I would say in Europe look interesting, but actually our core portfolio is still 60+% US. So I think it's the European stocks today that have been dislocated last year that I think look a little bit more interesting on a relative basis.
Thanks for stopping by. Thanks for coming to see us. Obi Ejikeme, Global Equities Fund Manager, joining us from Carmagnac. Thank you very much indeed. Mentioning some of the names that are on the Core 6, let's take a look at how they're performing this morning. We've already mentioned Novo is and remains under pressure, yet to fill the gap that it generated back on December the 20th. Ferrari's a little soft as well. We'll keep an eye on what's happening in the broader also space. But technology catching a bid this morning. ASML's up, Schneider's tracking a little bit higher. Even Nestle's having a slightly better day. But LVMH is the outperformer, up by 0.4%. Let's see what else is happening. Over to you, Joe Easton.
So we are seeing a gain in Next shares this morning in London. Guy, remember the company reporting sales up around 6% in the key Christmas weeks, the 9-week period. They do warn of some timing effects and also the impact of the rise in national insurance. That was announced by Rachel Reeves a few months ago, taking the shine off that. But a decent gain nonetheless, up 2% for Next this morning. Then in terms of Sodexo, that one getting hit hard over in Paris today, a really big decline. We're down almost 7% for Sodexo. This is around a €10 billion catering and facilities management company. It's the facilities part of the business that does seem to be weak, according to analysts following their trading report today. So that one, a really underperforming stock this morning on the French market. Then we got Prosus. Remember the big move in that one was yesterday, of course, falling around 2% on those headlines around Tencent and potential links to China, the Chinese military flagged by the Pentagon, so down around 10% on a two-day basis for Prosus now, one of the most favoured tech stocks on the street. But one tech stock going up this morning is Kion. Now, this is a semiconductor-based company. They do work with some of the big firms and robotics as well, and they've got a pact with Accenture and also Nvidia, according to a recent statement. That was announced over at a big conference in Las Vegas, a robotics deal with Nvidia and Accenture, boosting that one up 8%. That was the best performer that I saw at my screen earlier today. Then lots of ratings once again today. Analysts getting them all out as they come back from Christmas. BE Semi, a big outperformer today. UBS reckons they're about to see a big rebound in demand for some of their chip supplying products. But meanwhile, Alstom, that one really caught my eye this morning. Goldman Sachs cutting this one to sell this morning. Not many sales on that stock. It's down 4% today. Goldman reckons spending in the rail sector is going to decline this year, and therefore they recommend you sell shares of Alstom in that one. A big underperformer today, down 4% for Alstom in France this morning.
All right, Joe Easton from our equities team, we thank you. With some of the big movers at the open, as we're looking at the Stock 600 lower 0.4%, the FTSE 100 even more low, 0.7% down this morning. The CAC 0.3%, and the DAX down 0.2%. Told you it might be a bit of a tepid Tuesday. We'll dig into perhaps why next. Nvidia unveiling new chips and software as it looks to stay ahead in the race for AI supremacy. But has Jensen Huang done enough to impress the markets? We'll bring you more on that next. This is Bloomberg. Welcome back to the opening trade. We're 20 minutes into the cash session here in Europe. The Stock 600 down 0.4%. Perhaps a bit of caution ahead of the Eurozone inflation numbers later in the day.
We'll look forward to that data, figure out exactly what all those numbers are going to mean. The market, though, feels like it's very much on an AI story this morning. You've got what is happening, obviously, out in CES, but you've also got Satya Nadella, Microsoft Satya Nadella, speaking in Bangalore. I've just been listening to what he's been saying in the break, talking very much about the use case that AI is going to provide and how Microsoft is going to try and disseminate the AI story into a broader and broader range of topics. Let's take a quick listen to what he is saying in Bangalore.
These data centers are just, everything from how we think about even the construction of a data center that is optimized for liquid cool AI accelerators is a new engineering feat. And so that's what we're doing. Everything from how do we then work with upstream from us with renewable energy folks to get onto the grid base load that comes to our data centers that then has the right cooling infrastructure with zero waste and zero water usage. How do we really make sure all of that gets built into at a system level? And then, of course, silicon innovation. We're innovating with NVIDIA. In fact, today, I think, we have our first GB200 clusters up live in one of our data centers. Very excited about what that would mean. We are then also working with AMD. We are building out our infrastructure we are building our own silicon with Maya. All of these, in fact, Maya today is taking a lot of the customer service traffic in Microsoft.com. So we are building, I would say, world-class AI accelerator infrastructure, but the entire system stack above it, optimized for training, optimizing the kernels for inferencing. So that is significant investment and innovation that's happening through us, our partners, and so we're very excited. In fact, I think of this as a golden age for systems when it comes to innovation. Now, if you have the infrastructure, the next big consideration, in fact, today I met many partners, many customers. The first thing everybody wants to talk about is, it's fantastic, we're talking about AI, but how do I get my data in shape, right? I mean,
he's on a roll, isn't he? He's talking about a lot of investment. He's talking about a lot of big things coming down the pike towards Microsoft, towards its customers. The use case for AI a big feature of what he's been mentioning in Bangalore, but the investment that backs it up, a golden age for systems, that's going to require an awful lot of money. He's talking as well about the energy story. It was interesting, a few days ago he was talking about the idea that he's not chip constrained, he's energy constrained right now, and that is one of the big challenges that the AI story is generating right now. How do you broaden this out is something that we're hearing as a clear theme. You heard it last night from NVIDIA. You're hearing it from Microsoft now. Let's get more on this. Tom stepped out of radio. He's here with us now. Tom McKenzie, nice to see you. Well, I want to join the dots for us between what Satya Nadella has been talking about, what Jensen Huang has been talking about. What are we guessing at the beginning of 2025 that is in some ways different to what we got in 2024?
Well, top line, what we're getting that's the same as 2024 is you're not getting any walk back in terms of the enthusiasm when it comes to the spend.
He's definitely on a roll,
you can
isn't
sense there's no way they're walking back from this in any way. They're doubling down. And that commitment around the 80 billion capex spend this year, which led to some of the upside that we've seen in tech so far this year, earlier this week, that is a tell, isn't it, in terms of Microsoft's commitment to this space. Look, he talked in terms of joining the dots. He talked about partnering with NVIDIA, but also AMD as well. And that gets us to the question as to how Jensen Huang is positioning. And you touch on this. He wants to broaden it out into other segments. Jensen Huang, the CEO of NVIDIA, is clearly conscious of the fact that their competitors are coming up. They're a long way from catching up, but clearly he needs to diverse the product mix. And that's what we heard in terms of this speech, keynote speech at CES, where he talked about not just the hardware, but the software component. And it's a reminder that NVIDIA isn't just a hardware play, it's a software play as well. It's got the Coda software that goes with its AI accelerators, but also they release, for example, a foundational model that developers can tweak and use. It's going to produce new synthetic data. Data is a choke point as well. Interestingly, on the energy front, Satya Nadella talking about the energy constraints there. Sam Altman of OpenAI, clearly a partner with Microsoft, said that nuclear fusion is going to solve that question when he spoke to Bloomberg yesterday. So some of the key lines coming through from Jensen Huang, look, the commitment around pushing out to robotics, agentic AI, embedded AI into hardware, into autos, and we had some examples of that, into robotics, talking of a vision and a future where you have 1.5 billion humanoid robots and autonomous vehicles. The question for some analysts is how you make it cheap enough in terms of the hardware getting into those systems to make it compelling.
Well, that was literally going to be my question, because in this conversation that we just kind of dipped into for a moment, he's talking about $3 billion of investment in India. He's already partnering with the local kind of Ambani family-created communication system, Jio, and he's talking about partnering with the government as well. Is this the way to diversify regionally when it comes to making this cheaper for everyday use and expanding that use case?
So there's a parallel, isn't there, between what Satya Nadella is doing in India and those partnerships at government level with what we've been hearing from Jensen Huang, who's talked, and he talked about this last year as well, sovereign AI, so really trying to lobby governments around the world to build out their own, if they have the capacity and the financial means, to build out their own AI clusters. That has been a key driver for Jensen Huang. You expect that to continue as well. But also just at the kind of the more consumer level, whether it's in terms of how we interface with cars going forward, the partnership that Jensen Huang and NVIDIA have tied with Toyota, the fact that you're going to have screens and interfaces in cars now, they're going to read your facial recognition to make sure you're not falling asleep at the wheel and giving you more insights and more data in terms of the road conditions coming up. All of that is the future NVIDIA's looking at, if they can meet the price point and if they can get the efficiencies.
Basically, if you can explain it and if you can afford it, therefore, that's the way you get into the hearts and minds of everyone using. Bloomberg's Tom McKenzie breaking us down the AI story. Bloomberg's Ed Ludlow. We'll be speaking to Jensen Huang at CES in Las Vegas at 4:30 p.m. UK today. Stick with us. This is Bloomberg. This is the opening trader at 30 minutes into today's session. Red on the screen across the board when you're looking at the continent. The sole outperformer is actually the Swedish stock index. There's some interesting plays there, but broadly you are seeing red on the screen across the board, and perhaps a little bit of paring back some of the moves that we saw yesterday. The outperformance in tech, certainly the hindrance for today. And we're also on top of that getting a host of inflation data from Europe out today. CPI ticking higher across the region. Bloomberg's Zoe Schneeweiss in Frankfurt joins us this morning. She's all over this story. Zoe, we got Swiss CPI, we got French CPI, we're going to get the Euro area CPI and Italian CPI in a little bit as well. What is the common theme here in a backdrop where so many people are talking about preparing for some sort of cost push inflation?
Yes, so the overall trend we're seeing here is an uptick in inflation for the December read. We've already had that last week when we got the Spanish number, and now, because of the holidays, they were delayed a little bit. We got German data yesterday and French data this morning, and all of them see that uptick. The German uptick was a bit stronger than anticipated, the French not quite as strong as anticipated. Overall, though, all that will filter through to the euro area number, which we get in about an hour and a half, and that number is likely to see an uptick. In November, it was at 2%. Inflation in the euro area stood at 2.2%. Now we get the December reading. The economist estimate here is that it will be at 2.4%. Given the very strong German print, it could have been a tad stronger, but still, overall, there'll be an uptick here.
Am I going to hear the word gradual a lot more, therefore, as a result of this? The ECB increasingly gradual. I'm not sure how many variations there are on gradual, but does this impact the rate path, this data?
So it does give those members of the Governing Council some support who says we should stick to 25 basis points. Gradual is the overall theme, though. So the overall expectation here is that at the first 4 rate decisions of the year, and because of the timing of ECB rate decisions, that would be the decisions through June, there will be 25 basis point cuts at each one of these meetings, which would take the deposit rate from currently 3% to then it would be 2%. There are some policymakers, especially the Austrian, who say, hey, we maybe should wait a little bit. And others have said we can stop one meeting, and others have said that if needed, 50 basis points, which is something the ECB hasn't deployed in this rate-cutting cycle, could be on the table as well. Overall, though, the general consensus does seem to be 25 basis points. Given all the uncertainties that are out there, the German elections, the situation in France, and then, of course, Trump tariffs, that isn't completely surprising that they'd want to be cautious here.
Well, yeah, just talk us through what other risks are out there, Zoe, as we head towards this next ECB meeting at the end of the month. It sounds like I shouldn't be cancelling my next flight to Frankfurt.
Yeah, so the rate decision is on January 30th. That, in a way, is an inconvenient day for the ECB, because that day also is the day that the big euro area economies all say how they performed in the 4th quarter of last year. Overall economic weakness is something the ECB is quite worried about. Because if the economy is weak, that feeds through to inflation and stops prices increasing. And as we know, the ECB does want price increases of about 2%. So that's the one issue. Then we've got the German elections, which are just a month and a half away, where we are very likely to see a regime change in Germany. We've got all the uncertainty over France, where it's really unclear how this new government is going to get through a budget. And then, of course, the Trump tariffs is one of the things. We saw how markets reacted yesterday with all just the reports and then rejections of reports regarding Trump tariffs. So anything that happens there does create a lot of uncertainty, and also tariffs, if they are implemented themselves, and then if there might be retaliation, that just has a huge impact on the euro area economy and therefore on the ECB.
All right, Bloomberg's Zoe Schneeweiss in Frankfurt. We thank you as we walk towards that euro area inflation print at 10 a.m. London time. But staying with the economics and how it feeds into the politics, let's go to Canada next. Justin Trudeau becoming the latest world leader to be toppled by a struggling economy, and following very much in the wake of US President Joe Biden, Rishi Sunak as well in the UK, and Olaf Scholz appearing set to lose next month's election in Germany as well. Let's tie this all together and bring in Bloomberg's Oliver Crook for the European implications. Ollie, just talk us through this instability that we're seeing across developed economies.
Yeah, so listen, Lizzie, I mean, I think it's fundamentally connected to exactly what Zoe was talking about, this issue of inflation, where basically you've had this phenomenon, obviously, since COVID, and we're still sort of grappling with the political consequences of it, the sort of extreme inflation across the Western world, where effectively, you know, people who are earning money, who do not own assets, the value of the money goes down, and meanwhile, the value of assets is going up. It's effectively a sort of wealth transfer from people that don't have as much to those who have a great deal. That is being felt politically, right? This is the sort of theme that we've seen across across the world, the inflation, the cost of living. This is what has led to a lot of the oustings of many of these governments. But it's not just that, right? There's also this question of climate backlash, this idea that basically that we're putting these sort of principles and these ideas above basically the day-to-day practicalities of having cheap sort of energy costs, and of course also seeing it sort of materialize in immigration. I mean, I was just looking at the G7 leaders. I mean, if it's really remarkable, you pull up the screen of all of the sort of G7 leaders. In the last year, they have either almost all been replaced, are incredibly weakened, or about to be sort of pushed out, whether it's Joe Biden, Olaf Scholz, and now Justin Trudeau. I mean, there was an election also in Japan, and Keir Starmer, Macron. The only person on that board that is coming from any sort of position of power is Giorgia Meloni, who's been holding on for a while now. And, you know, that was after a sort of a long period of instability over in Italy. And when you think about the sort of global ramifications of this, I mean, the G7 is supposed to be the stable core of the multilateral order. That is not at all what we have going into this year, where Canada actually is supposed to take over the presidency of the G7.
Quite the timing, of course. But a lot of those issues that you just outlined, inflation, immigration, among others, they're actually driving the story in Austria as well. Give us the state of play there.
Yeah, so listen, Kriti, I mean, it's so interesting because it's like there's so many echoes in this Austrian story that we're seeing across European politics. You know, now you have basically the sort of far-right leader, the leader of the Freedom Party over in Austria, Herbert Kickl, who won the election over in September but was not given a mandate to sort of form a government because nobody would work with him. He was basically boycotted. Now the chancellor has resigned after they could not bring together a centrist coalition. And what you have now is likely Kickl, who will work now with the new head of the Conservative Party in order to form a government. Now, his platform, he's running on sort of anti-immigration, so-called Fortress Austria. This was sort of to suspend asylum seekers and to deport people. There's, of course, the pro-Russian bent. He sort of doesn't want to support Ukraine, wants to see sanctions go off of Russia. And, of course, not only climate skepticism, but also sort of EU skepticism. Now, he doesn't go as far as the AfD does, for example, in Germany. He's not calling for an exit of the euro, but he is very, very skeptical of the European project. He is also going to be leading Austria. This means that there is another party as a head of a member state at the European level that joins Orban's group, the Patriots for Europe, within the European Parliament. That makes things a little more complicated.
Are alarm bells finally ringing in Brussels?
I think they're ringing very, very loudly. I don't know that they're actually, frankly, ringing sort of loud enough. You try to tie all of this stuff together because what this commission is trying to bring together, Guy, is not just a sort of little bit incremental move in the EU. What they are actually advocating is a giant leap forward of European integration. They want to see it on capital markets and banking. Every single one of these ideas comes with a cost. On capital markets and banking, for example, you need supervision. You need to surrender some sovereignty. If you want to see European champions, the cost of that will be some national champions. If you want to see collective defense, you want to do more spending, you're going to have joint debt. If you want to focus on climate, these are all things that there is a huge amount of resistance to at the sort of national level. These are not the ingredients that you have in place in order to bring a sort of Europe to a giant leap forward. That is going to be a focus for the European policymakers here. And we're going to be speaking to the competition commissioner. This is the new position that has been made, an executive vice president by Stéphane Séjourné. This is out of Macron's party. This is the person charged with European competitiveness. We'll talk to him a little bit later. Are the ingredients here to make Europe, great again, or is it going to be basically paralysis into sort of economic demise, as Mario Draghi and Macron are warning about?
Make Europe great again. We'll see what happens on that front. Ollie, thanks very much indeed. Tying all the threads together in terms of the politics and the impact that we're seeing around the world. As he says, we have a fantastic conversation coming up for you right here on Bloomberg, an exclusive one with the EU Commission Executive Vice President Stéphane Séjourné. You'll be able to catch that interview Wednesday right here on Bloomberg Television. Looking forward to that. Let's talk about the market implications of all of this. Monday starting a little quietly when it comes to the currency options market. It changed as we saw the WAPO story coming through, the Washington Post story. Then we saw the rebuttal from Trump. The euro's been all over the place, but we've got a 104 handle right now. What are we going to see in 2025 when it comes to the currency markets for the single currency? What are we going to see? Valerie Tetel has joined us around the table to make some predictions, which seems like something that's only the brave are doing at the moment.
Yeah, well, I think the one thing we know for certain is volatility in FX is here to stay. I mean, what a session yesterday. You had the first day coming back from the holiday all ready and prepared with your euro shorts. In that WAPO article, you get massively stopped out, and then you miss the snapback on the Trump denial. I mean, we saw that in the FX currency markets yesterday. Some reports out there from Bloomberg reporting saying that we had such a very large volume surge in FX options. A lot of those bets and options market on euro parity seem to have been stopped out on day one of liquid trading for the year. And, you know, going ahead, it's going to be a volatile one. I think markets hope that we get a clear message from Trump on what he intends to do with tariffs. But we're hearing from the street that, you know, we're really unlikely to get that. George Saravelos at Deutsche Bank saying we should not expect one specific implementation timeline. We should be getting ready for overlapping legislative and executive initiatives, rolling deadlines, and various announcements, not just throughout January, but throughout the entire year when it comes to this tariff situation. So we're buckled in for some volatility on the FX market. Some they're out there licking their wounds already on their euro shorts.
In the meantime, taking off some of that duration risk as well.
Yeah, that's right. I mean, another theme, if you can call it a theme, we've only had 3 days or so of trading of the new year, has been weakness in the Treasury market, prevailing weakness in the long end. It has gone global. We saw Japan JGBs in the long end reaching levels not seen in 15 years. And then here in the UK, the long end of the UK gilt curve seems vulnerable as well. You saw 30-year yields yesterday nearly touching 520 on the 30-year gilt yield. And again, you know, you think about the vulnerabilities out there. One mind goes right to the UK, where you have fiscal headroom being eroded, not because of anything happening in the UK, but because of what's happening with the U.S. Treasury market, where it's pushing global yields higher. You have to also think that in the UK, they have a very long duration in terms of their average debt maturity. It's around 15 years. So they're more exposed to this winging around of long-term yields than, say, any other European economy. It's going to be an interesting one, especially when it comes to the UK, because of one reason is that their FX did outperform last year. If you look at the currency pair of sterling specifically, it was the best performing currency pair last year. And normally you get a bout of currency weakness that almost helps you stabilize some sort of economic weakness. And we didn't really get that in the UK. So I think there is starting to be some correlation of mind that the UK is going to be a weak spot when it comes to this rise in global yields.
I mean, how worried should Rachel Reeves be? Because we were talking about these yield moves anyway, because she'd left herself so little room after the budget. It seemed like maybe she'd have to come back again. Does that now seem inevitable that in the spring she's going to have to come back for more?
Look, we saw the FT reporting on this last week, that they could, in fact, have to maybe change tack with what they've done. We've had 2 back-to-back months of zero growth. And alongside of this, we have yields marching higher and the currency not weakening to give us some sort of stabilization. So it's going to be an interesting one to watch. Lizzie, I know you'll be on top of it as well. But yeah, the UK does seem to be the one that could be vulnerable to any further sustained steepening of the Treasury curve.
All right, Bloomberg's Valerie Tetel, we thank you. Unless you want to ask about the yen, Kriti.
No, while we're at it, we're talking about stability and all. Talk to us about the yen story. I mean, you mentioned the verbal intervention, the jawboning earlier in the show. How digestible is that? We're looking at a 157 handle.
Well, look, if you're one who is piling into this U.S. exceptionalism trade, you want to be long dollars. The big risk to that is a hike sooner than expected from the Bank of Japan that would weaken the dollar. We saw the hints of that overnight. There was some verbal intervention when the yen hit a 6-month low at 158.50. It nearly hit. The last time we saw sizable FX intervention was around the 160 handle. So maybe we're still a bit farther away from that, but it's still something on the top of investors' minds when you think about if you want to be positioned long dollars into this year, one of the biggest risks to that position.
All right, Val, thank you. Good to have you with us this morning. And coming up, we're going to touch on Guy's favourite subject, one of them, used Rolex prices. I know he loves a bargain. Falling to 3-year lows. We'll bring you the latest from Bloomberg's Subdial Index next. Do stay with us. This is Bloomberg.
Welcome back to the opening trade. Around 48 minutes and change in today's session. Seeing the losses that we opened the day with kind of getting pared back a little. Not so much excitement in the fact that we are still flat on most of the major indexes. Barely marginal outperformance in France there, and underperformance, I should say, right here in the UK. The FTSE 100 down at 0.3%, but still a positive move from where we started in just 48 minutes time. Now, a lot of this may have to do with some of the moves that you're seeing around a lot of the political news, and that certainly is a major theme this morning, specifically when it comes to the relationship between the U.S. and China. Shares in China's gaming giant Tencent and global battery manufacturer CATL dived in Asia trading after the U.S. blacklisted the firms for alleged links to the Chinese military. Joining us now for more is Bloomberg senior reporter for the Chinese economy and government, James Mager, joining us this morning. James, bring us up to speed on this blacklisting. What does it actually mean to be on this list?
There isn't any actual immediate effects that being listed on this list from the Department of Defense will have. People can still do business with them. You can still contract with them. GM or other American car companies can still buy batteries from CATL. There is a provision in the future that the Department of Defense may not be able to contract or to sign contracts with these companies or to buy goods which contain goods from them. So maybe in the future, this would affect their sales in the US. But the biggest sign, I think, is the fact that these companies have now been targeted by the US government, and this could lead to to more strict sanctions, like from the Department of Commerce or the State Department in the future. And even if that doesn't happen, there's still, the US government is signaling very strongly that they don't want US nationals dealing with these companies. And you already saw last year, you saw CATL batteries being pulled out of a US military base after Marco Rubio and other lawmakers complained that Chinese batteries were being used to power in an energy storage solution in a US military base. So even before they were listed on this, even before CATL was listed on this list, you did already see them losing some business opportunities in America, and that may well continue. Once we get into the Trump administration, especially if Marco Rubio and other China hawks are populating senior positions in the administration.
So you've got Tencent saying they're not a military company, but how much scope is there for the companies on this list to challenge being on it?
Some companies have successfully challenged being listed on this specific list, the Department of Defense one. Hersey, for example, which makes LiDAR, which are used, basically it's kind of a laser that cars, EVs use to sort of, make a map of the world in front of them. They were listed and they were removed, and then they were listed again and then they've been removed. So there is some possibility that Tencent can basically sue to get off this list. But they could also be added back on if the Department of Defense then doesn't accept their explanations on why they shouldn't be on the list in the first place. But it also does set them up for future possible listings by the Department of Commerce, as I said, and it just makes them more of a target, and it makes them a little bit less attractive. If you want to make an investment which isn't going to attract any geopolitical risk, are you going to invest in a company or invest in a fund which is invested in this company, which may well have this risk attached to it now or in the future? It just makes them a little bit more unattractive, and I think you saw that price reaction today in the market, with those big stock price falls for Tencent, CATL, and other Chinese companies. Because it's not just those two firms; it's companies like SenseTime, it's Changxin, which is a huge Chinese semiconductor, shipbuilders, shipping companies. They're all on the list today, and they all saw these kind of price reactions.
We're starting to see some reaction, though, from the companies. Tencent intending to initiate a reconsideration process. How long does that take? What is the process? How quickly can it have an effect? Other companies have been successful in these efforts. What are the chances here?
I mean, the chances are up to the Department of Defense. They get to decide who is on the list and who is not. There's no legal process for which this can be challenged, as far as I understand. Basically, the companies now have on the notice it says, please send your objections here, and please give us reasons why you shouldn't be on this list. So, Tencent or the other companies can now have their lawyers write up a document saying why they're not connected to the military and why these accusations are wrong or misleading or false. And they can send that to the Department of Defense and ask for a reconsideration. I'm not sure how long that will take. For Hersey, the process of being added and then subtracted has been quite lengthy over the last couple of years. But we'll probably see this playing out in the future. But this is part of the U.S. sanctions toolkit on Chinese companies. There's many, many other kinds of tools that the government can use if they want. In the first Trump administration, the Trump administration banned U.S. nationals from investing in companies that were connected to the Chinese military. But that, again, even if you're not on this list, that could be damaging for other Chinese firms as well.
Thanks for the update, James. Really appreciate it. James Mager joining us out of Beijing on the latest out of the United States in terms of the restrictions that are being applied to Chinese companies. Let's turn our attention to another subject. The prices of the most sought-after used Swiss watches have fallen again, hitting a 3-year low, in fact. The Bloomberg index of the 50 most traded models fell nearly 6% last year, which is a continuation of a theme. Let's bring in Bloomberg reporter Andy Hoffman out of Geneva on this story. Andy, wasn't it just a few days ago that Rolex turned around and upped its prices? And we talked to you about this, and yet we've got the second-hand market, the used market, falling. Can you kind of put these two stories together for me? Is there the demand or isn't there the demand?
It's a very good question, Guy. Yeah, good morning. So, indeed, Rolex raised prices, with some gold models 8%, even 12 or 13%. We saw that to start the year. But we've seen used watch prices, the secondary market, prices fall again in 2024. That's after falling in 2023. They fell at an even faster pace that year. And in 2022, they really took a big dive. Now, these are two separate yet interlinked markets. Rolex makes about 1 million watches a year. The primary market is worth about $50 billion a year, we estimate. The secondary market, where we've seen all this action and negative price momentum, is worth about $20 billion a year. So there's a lot more supply, obviously, on the secondary market. There's a lot more trading going on. There's only so many new watches that people want, that people can buy, particularly for Rolex. With the secondary market, you can get pretty much any watch, any luxury watch that you want. The question is what you're willing to pay for it. And what we saw last year was buyers and sellers driving down those prices by about 6%, according to our Bloomberg Subdial Watch Index, and that's the 50 most traded watches by transaction value, mostly Rolex, some Patek, and a bit of Audemars Piguet in that index.
Andy, very quickly, geographically, who's buying this? Where is most of the growth coming from? Very quickly.
It's very similar to the primary market. The U.S. really drives this market. They're the big buyers, but the U.K. is a very sophisticated, strong market. Japan is, a long innovator in used luxury watches. The Italians are the tastemakers always in the premium watch market. They're the ones who decide what's cool and what isn't. And so, yeah, it's quite similar. China, obviously, is a growing market, but as with the primary market, the Chinese economy and the Chinese buyers are a little subdued.
Well, certainly we'll see if that changes some of the stimulus being pumped into that economy. Bloomberg reporter Andy Hoffman on the latest on the watch sector. We thank you so much. So what did we learn today? We learned that, of course, China, the geopolitics, is a little bit of an overhang when it comes to battery makers, when it comes to technology. At the same time, when NVIDIA and Microsoft are going full throttle into that sector. Later today, Bloomberg Technology will speak with Jensen Huang at CES in Las Vegas. That coming up at 4:30 p.m. UK time right here on Bloomberg TV. That does it for the opening trade. The Pulse is up next. This is Bloomberg.